Hi, everyone. It's Kali Persall, editor of Institutional Investing in Infrastructure, here with Adrian Mucalov, partner and head of the long life infrastructure business at Actis. We're going to challenge some misconceptions about emerging markets, or as Actis likes to call them, growth markets. So, to kick off, Adrian, can we just start with having you say a few words about your role at Actis?
Thank you very much, and thank you for your interest in what we're doing at Actis and across the world's growth markets and sustainable infrastructure. So my name is Adrian Mucalov. I've been with Actis for 16 years. I manage today our long life infrastructure business globally from my base now in Singapore. I used to be part of our energy team, so I have a power sector background. Our long life infrastructure business, our focus is to invest in high quality, long-term contracted operating infrastructure assets across the growth markets.
Well, thank you so much for taking the time to be here with me today. Recently, I interviewed you for a feature story I wrote on emerging markets. Can you just talk a little bit about which growth markets Actis is invested in and what makes these markets so attractive for infrastructure investment?
Yeah, our focus is on what we call most of the world, where about 85% of the population lives. So that encompasses basically all of Asia, Latin America, Eastern Europe, Middle East, and Africa. And I think what's really compelling from an investment point of view is that these markets are typically high growth markets and have an enormous demand for critical infrastructure. But from an investment point of view, it's also the case that over 2/3 of all infrastructure capital goes to the developed markets, even though we see that over 2/3 of the opportunity, there are actually new assets that are being built are in our markets, right? So if you think of renewable energy, for example, is one of the big sectors that I'm sure we'll talk about. There is more renewable energy being built every year, in the growth markets than in developed markets. Yet the vast majority of the capital is still raised to be dedicated to developed markets and still invested in those markets. So naturally, when there's so much competition, right, in North America, Western Europe, Australia, that has an impact, we believe, on risk-adjusted returns. In our markets, that we're talking about investing really in critical infrastructure. I think that's also one of the characteristics. There's vast opportunity to invest in real long-term contracted, critical infrastructure. So we're really focused on power generation, electricity grids, now digital infrastructure, roads, sort of classic long-term contracted infrastructure. And I think that our markets have really continued to mature. So we've been doing this for a long time, close to 25 years as Actis investing into sustainable infrastructure in these markets. And I think what investors see now when they look at the markets is that the regulatory environments have just continued to mature. There's now a very long track record in some of our markets of very successful private sector infrastructure. We believe that the investment opportunity just continues to grow, across that spectrum.
So, what sectors within infrastructure, whether it be energy, transport, digital, water, or anything else, what do you think are attracting the most investor interest in growth markets right now?
Well, the two big opportunities certainly are in the energy space, thinking about power, which I'll dig into, and digital infrastructure. Those are the two sectors that everybody's talking about. Those are the two largest opportunities. We also invest into transport infrastructure, and we look at water and waste and other categories as well. But the power sector alone, if you think of the demand for power that's going to come in the next generation, right, as a planet, we now will need to basically double the amount of power generation that we have, and we also need to replace a lot of the existing power infrastructure with energy transition and renewable energy assets over time. So if you combine just the natural growth of just demand for power in general, as well as the demand and the need for more renewable energy, it's sort of one of the opportunities of a lifetime from an investment point of view. So that's very compelling. In our markets specifically, that's what's part of what's really exciting is that the wind speeds in our markets, in many of our markets, are very high. The solar irradiation is great. So kind of the renewable resource is particularly strong in many of the growth markets. So if you literally have the exact same equipment and the exact same wind farm, northeast Brazil or in South Africa or in parts of Egypt, places that have some of the world's best wind speeds, you can get 2 to 3 times as much power for the same equipment that you might get in other parts of the world. And I can tell you the same story about solar because many of our markets, have high temperatures and good solar resource. So what that means is that actually renewable energy in most markets is really the cheapest form of electricity today, right? So therefore, it creates a great investment opportunity when you combine that amazing resource, really low cost power in countries that need the power, right? So that's sort of the starting point. There's also a big need to invest into electricity transmission and distribution in the grids, and especially if there's more renewable energy, the grids have to be invested in to accommodate the intermittency of renewable energy. So we say, you can't have energy transition without transmission, right? You also need big investment into transmission. And we've seen some studies that say, for every dollar you invest into generation, you need to invest about a dollar into transmission and distribution. We're also investing heavily into that sector. So if you think of power broadly, we think of renewable energy. We do invest still in gas-fired generation, which in many markets is the natural complement to wind and solar as part of the energy transition story. And then we invest in the grids. So that's on the energy side. I think the other big theme that is obviously getting a lot of attention these days is digital infrastructure. So within that, we have data centers, powers, and fiber. We've invested in all of those sectors. All of those sectors are growing rapidly in our markets. It's becoming, say, in towers and fiber, the same thing that's happened in developed markets is happening in our markets where those assets are being carved out. They're being invested in by private sector infrastructure investors as sort of as designed as infrastructure assets, where traditionally a lot of them were owned by telcos or by state-owned enterprises. But the biggest opportunity in that space is clearly data centers, right? And these are huge assets that require hundreds of millions of dollars often. And the same trends that we see globally of just increased use of the internet, increased need for data, and then obviously especially now burnished by the explosion of AI and machine learning. So in our markets, you have both of those dynamics as well, where you just have a growth in fundamental need for reliable digital infrastructure, even before the advent of modern AI. The data center capacity in our markets is just far lower than it needs to be to just provide basic, kind of cloud services. So again, it's this supply demand gap is what really creates the compelling investment opportunity. Then on top of that, you now have the opportunity in some of our markets to invest in with the hyperscalers for AI needs, and they're working with the clients to figure out where the hubs will be across Latin America, across Asia, across Middle East, for that kind of service. But that is happening, and what's interesting there, of course, that the data centers don't necessarily have to be quite as geographically proximate to the users as you do where you have latency issues for kind of typical data centers that you need to be close to the user. So it's a massive investment opportunity, and we're investing heavily into that through our different fund strategies.
So I know investing in growth markets is a lot different than developed markets. I also know that not all growth markets are the same, even though sometimes they're painted with the same brush. Just what are some key challenges investors are facing when investing in infrastructure in these markets, and how can they navigate them effectively?
Yes. So thank you for that comment, because I think it's an important point is to say that not all growth markets are the same way that I would say not all developed markets are the same. And there are over 100 different countries that are considered emerging markets or growth markets. And we've actually developed our own tool that we call the Actis Atlas to look at the world a different way. Because we think traditionally, often investors think of just developed or emerging, or they think of OECD and non-OECD. But we think, really those are pretty antiquated titles. And, we divide the world in different ways. We say countries that export a lot of natural resources are very different from countries that are linked into other kinds of global supply chains, which are very different from countries that are sort of small and stable and maybe more domestically focused. That's the way we think of the world. But then you have to really drill down to the infrastructure sector. And you're right. I think a lot of investors have had experiences in our markets in other categories as well. Maybe they've invested in the stock market, for example, and they've had a bad experience somewhere in the stock market. But that the infrastructure sector has many features and characteristics that make it really attractive for foreign investors. And most of our markets really depend on equity investors and even debt investors from abroad to fund their enormous growth in their infrastructure programs. And again, we're talking about real fundamental critical infrastructure here, power, roads, data. So in order to attract that capital, the contractual structures that you're able to get in our markets are often really attractive. So it's really the specialty to be able to understand and analyze which of the markets among all the markets that you could consider are the ones that are large, exciting, have the right regulatory environment, have the right track record in infrastructure. So there are probably about 15 or 20 countries that we're really focused on as the primary investment destinations within Asia, Latin America, Eastern Europe, Middle East, Africa. So we believe that the actual risk in those kinds of markets that have that long track record is frankly lower than the perception of risk. And that is one of the main reasons why there's so much capital flowing to developed markets, because traditionally a lot of the infrastructure investors are from those markets and have a perception that investing abroad is riskier. And I would say if you're investing in the US, there are some great long-term contracted safe infra investments, and there are many risky investments. I would say the same thing about Europe, and I would say the same thing about our markets. It depends what's the nature of your fund strategy, and how much risk tolerance you have. But the strategy that I lead, the Long Life Infrastructure Fund, is designed as a low-risk core infrastructure strategy. And if you're investing in long-term contracted assets that are already operational, that have great contracts, that have great off-takers, that have a strong regulatory regime, that have many layers of downside protections, you can have a lower risk strategy. But we still think the supply-demand balance leads to pretty compelling returns. So I wouldn't say that actually investing in infrastructure in our markets is fundamentally different. I think you should always be looking at the same kinds of questions. What's the risk allocation? What are the risks that you're taking? What's the off-taker taking? What are your contractors taking? What are the protections that you have in the contract? Do you have the right management team? Do you have the right off-taker? I actually think it's really the same questions. And the key to success really is experience and understanding of the markets. And that's where almost all of our investment professionals live and work in those markets, have been doing it for decades. And so it is very detailed work, the same way that it would be, if you're working in Europe or the US. So, I think it's difficult to be an investment tourist, if you're working and living abroad and occasionally investing into our markets without really understanding them deeply. But that's not a reflection on the markets. I think it's a reflection on the fact that, it is very detailed work. It is very contractual, and you really have to understand the detailed framework of the regulation of every subsector and exactly what you get in your contracts and in your assets.
Yeah, that's very well said. And that kind of leads into my next question. During our other interview for my story, you mentioned that misalignment between perceived risk and real risk when it comes to these markets. I know you just spoke about maybe a few of them, but are there any other misconceptions that you kind of want to clear up about emerging markets, being compared to developed markets?
The general perception, usually what people are worried about is, are you going to get paid, basically? And is the regulation stable? Is the regulation going to change? And, again, I would say you have to do that analysis in any market where you're operating. If you're investing in India or you're investing in Brazil now, if it's in a renewable energy or electricity transmission or roads, there's like 20 or 25 years of track record. Most of the Latin American markets have been attracting private sector infrastructure capital since the reforms of the late 1990s. So again, many investors have maybe some experience from, 10, 15, 20 years ago, but today there's a lot of track record. So you can see what's happened. Have the courts defended private sector rights? If there are, regulatory disputes, what's happened across political cycles. So you don't have to sort of take a guess and a bet of what might happen. The track record is there. And I think that's really what's changed as our markets have matured. And that allows these different strategies to flourish. So I would encourage investors always to conduct the diligence. And it is important, I think, to work with managers who have that experience, who've lived that, who have the contacts and networks on the ground. Because even though these are contracted critical infrastructure assets, there are always many things to manage, right? You're always still managing your various stakeholder relationships, you're managing technical issues. It is really important to have that experience in house and having lived that over the years and over the cycles.